Pretty poor line, Shankar. Just stay on with us. We're going to redial and get back that connection because it's very integral to get in your take at a time like this. Just look at what's going on with the markets as we speak. Pull up some heavyweights like ONGC, which have taken an absolute nosedive. In fact, it's the biggest drag on the index right now with a whopping double-digit gash of 12% at 78 rupees. Vedanta, IndusInd Bank, Reliance Industries, Tata Motors, as well as Tata Steel. So, Shankar, apologies for that interruption. Go ahead.
Yes, what I was saying was in terms of strategy, we saw a pretty decent fall globally and in India, of course, coming up, which we implemented the first week of February. So, while it is obviously, absolute meltdown, what we were seeing was that alternates away from equity will do better, and which is what you're seeing right now. Gold has done better, fixed income has done better. So we basically pivoted out of equities first week of February. So far, that thesis has been borne out by what we are seeing right now. To answer the question, does it get any worse? Things can have a force of its own, and they can, it's just like a big boulder sliding down, a mountainside. I mean, it's just gathering momentum as we go. It is not looking pretty as we are all taking the screen.
All morning, we've had a variety of speakers who've suggested not to panic, to buy in at dips, that things will stabilize. This is not the end of the world. What would you say to counter that?
So I've always believed that one should be smart in the market, but one should not be over smart. And, one should let things play out rather than try and, say that, okay, worst is over and all that. Anyway, nobody on your show has any clue about what this virus is and how it is going to end. So, I don't pay any attention to financial people becoming medical doctors. So my view is let this thing play out. It's better to buy 10% higher rather than just go in blindly and risk losing 20-30%. Remember one more thing, very important thing. People liken it to the SARS. But SARS happened in 2003 when globally and in India, markets had halved. So Sensex was 2000, in 2000 was 6,000. Around the time of the SARS, it was, I think, around 3,500 or maybe 3,000. It had already halved. So it depends on when a problem like this happens. It's not simply a problem, but the context in which that problem happens. Today, you've seen this at all-time highs in India, globally, when markets were anyway looking pretty vulnerable given the narrowness of breadth of India and in the US and elsewhere. And then when something like this strikes, you can fall a long way because you're at the highs, you're not at the lows, like when the SARS virus
All right. We're on a bit of a choppy line, but clear message coming there. We want to continue that conversation with Shankar, so hopefully we'll get him back on the line in just a moment. But he's saying, let things play out. I want to ask him, okay, Shankar, you're back. I want to ask you, like you said, none of us have any clue, but until we kind of understand where the bottom is going to be, would you stay out of equities altogether? As you said, you've decided to pivot out of them first week Feb, or would you look for opportunities at lower levels?
No, again, I must apologize. Line, I have a phone connection, so I don't know whether it's our problem, but it is really a line, so I must apologize.
No problem.
Hello?
No problem at all, Shankar. Go ahead.
So equities this year, I think, is a trouble spot. It's not to say there is nothing in equities, so we have India equities worldwide, but it is only the weight that we cut in the first week of February. So it is not a view that, look, there's nothing worth buying or there's nothing worth owning. It is simply that an aggressive stance in this market is something that is not warranted, looking at the way this thing is unfolding. The U.S. was the engine of growth for the world. It was the engine of stock market growth for the world. And there you're seeing numbers on this virus which are pretty scary. So, my view is it's not wise to say no equities, but obviously you just turn the dial away from equities a bit. That's pretty much what we have done.
away from equities at a time like this. But Shankar, you also have a lot of market experts, and they're also predicting a fairly gloomy scenario from here on, talking about a recessionary scenario across the globe. Are there fears of that as well?
Well, I mean, if you take broad estimates, crude doesn't go to 30 like this without a recession being in the works. Number one. Number two, obviously most of the listeners to this interview are going to be in India. So let's focus on India. The world was anyway in pretty good shape prior to this. It was the problem spot was India, where we were seeing 15, 20-year lows in terms of growth rates. On top of the already very, very weak economy, we have a problem like this. And that is what is worrisome, that it was not as if India was growing 8% and then you'd see a 2% cut and you'll go to 6%. You are growing 4.5%, maybe, I mean, that's also exaggerated. Maybe you're going at 2.5% and you get a cut like this. Maybe you lose a 1% point on growth, maybe 2% point. Then where does that leave you? And remember, again, I'm putting the context in. This is all happening at all-time highs on the Indian markets, at least in the narrow markets like the Nifty and the Sensex. It's not happening when the markets have fallen 50%. So when you already were struggling for economic growth, for earnings growth, we have not seen earnings growth of any meaningful, sort of quantum over the last 6 years. On top of that, this thing comes. I mean, what you're seeing on the screen, it was anyway going to happen, maybe not to this ferocity, but I've said this on your show that, look, a narrow market can run for a while, but when it collapses, it doesn't end well ever. It's never ended well. So the virus or something else can happen. There can be some other reason, but narrow markets don't end well, and that's really the thing that you're seeing happen here. So we have to worry about India. The world can take care of itself. The rich economies can figure things out. For India, I think it's come at absolutely the worst time possible.
And we're still waiting to see if we're going to see anything from the central bank on this. Apart from staples, possibly, Shankar, what does this really leave on the table as well? If one were to get down to specifics or themes in this environment, okay, we've lost the line. As he said, slightly bad line this morning, but clearly the message coming through in terms of strategy, saying it's better to buy 10% higher than to go into this blind. We really don't know what's going to happen, and we are entering a recessionary scenario. Given where we're at with crude, it's very clear the implications on growth going forward. Remember, India, of course, in a tough spot, given the weak economy. So while everyone's saying we're relatively better off given that we benefit from the crude fall, the fact that this is going to have a far-reaching impact on demand and growth is going to affect everyone, including us. And we're already seeing that, of course, even on the back of fund flows and on the back of attention shifting away from riskier cyclical assets that there are now concerns will even see that recovery that we were counting on or not. So just when you thought that volatility would be limited to the big event earlier in the year, which was the budget, this has really taken us by storm, and it's really been a roller coaster since the last week, 10 days or so, in terms of what we've been seeing around the globe and how we've been following suit as well. We're going to, of course, continue to bring you the best of commentary on the markets and coping with the sell-off. We'll also have for you some big voices on the Yes Bank saga, including Rajneesh Kumar himself. So we'll get you that. And of course, on oil, we'll continue to bring you commentary there. But remember, crude coming as a shock this morning with no one really having an idea as to where we're going to see it settle. It's already cracked that 30 mark. Still big question marks around how low the Saudis will let it go. Shankar, great to have you back. I was asking you what this really leaves on the table in terms of the current environment that we've described, apart from perhaps staples. What else does it really leave on the table to nibble on?
Well, I mean, again, remember one more thing, that last year, 2019, became a crowded trade for the FMCG kind of companies, right? I mean, everybody and his uncle was parroting this theme of buying quality and buying, high returns on capital and buying incremental ROC, which are very good and all that. I mean, that's all well and fine, but it became a crowded trade. And you've seen that this year, by and large, I mean, maybe 2.5 months of this year, those trades are not holding up particularly well. I mean, obviously, those are unleveraged companies. They will not crack like 50%. But you were buying them at such crazy valuations. And I mean, the interesting thing was everybody would say quality, but would never attach a price to that quality, right? So, 2019 worked very well for that trade. But since it became crowded and all crowded trades eventually end, that trade is also petering out. So the areas in the market that might not fall as much might actually be the ones that did very badly in the last 2 years, which are your small caps. As long as you choose well there, I'm not saying it's a safe place for a retail investor. It's a damn tough place even for professionals like us. But at least that place has already fallen 30, 40, 50%. There's probably little room left to fall. While for your mainline companies, for your over-owned companies, the over-owned trade, they can fall 30%. I don't see why a over-owned staples company cannot fall 20, 30%. Especially in an environment you're trading at crazy multiples. You have economic growth which is already very poor. And on top of that, you will obviously see some effect of the virus on Indian growth rates as well. It's not going to be immune to that. So, I mean, my view is that least owned part of the market is the small cap space. I think that's the only place where you can probably lose a little less. I think the large caps are over-owned, and that's exactly what you're going to see, that, you're going to see big cuts on that part of the market.
Shankar, I'm just going to deviate from the overall market meltdown and focus in on your recent tweet and, of course, what's making the headlines this morning back home as well with respect to Yes Bank. You've said that while you support the move, the only sore point is why make SBI and LIC the bakra? Let's get in your take as to what's playing out with Yes Bank right now and how you're looking at the RBI's move to write off the AT1 bonds of Yes Bank, because that really seems to be hurting appetite now, with IndusInd Bank as well deferring the AT1 bond plan.
Yeah, I mean, I know the AT1 has been a very, very controversial thing, and people have been asking that, how can that bear the brunt of, the write down while equity still has some value. But I mean, I'll tell you what, I mean, typically, and we do a lot of distressed transactions, at least we look at a lot of them, typically equity it is again counterintuitive. But in a distressed company, whether it's a bank or an industrial company, the bonds can go to zero while equity can still have some value. And that's counterintuitive. Usually bonds should have some value because they have some assets backing them, while equity is just an unsecured asset and should go to zero. But it doesn't actually play out the same way in real life. When equity will have some value, a stock will not go to zero. It will trade at 50 paisa, 1 rupee, 2 rupee, while a bond goes to zero, which is what you're seeing here. But I mean, the larger point with my tweet was this, that look, and this I feel very strongly about, that the entire brunt of building out infra in India, or building out industries that support infra in India, so a steel or a cement, and I mean all these ancillary services have fallen on the state-owned financials. While private sector banks have got a home run, a free run, just to go and sell credit cards to consumers and housing loans and whatever they're selling, while they don't touch anything to do with infra. And, I think that's just an unequal situation that India does need, infra. We all know that. Why should one end of the market enjoy, market caps of $100 billion or $50 billion, while the other end of the market, poor chaps have to keep shelling out bailout plan after bailout plan, whether it is a bailout for a divestiture or it's a bailout for a failed bank like Yes Bank. So I feel quite strongly about it that there should be some parity here. It can't just let SBI and IDBI become the dumping ground for everything that the world doesn't want to own.